Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 6 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis as we always do with our sectors: who was leading, who was losing, and where was the weight. The XLE for the energy sector led the pack today, up 1.23%, whereas down at the bottom of the barrel we see the XLK, the tech sector, the heaviest weighted component of the S&P 500, lagging on the day's session. It was not technically a loser, just a laggard, only up 0.06%, and that's as measured from the prior day's close. From today's open, we need to look one notch above to the XLV, the healthcare sector, ironically the second heaviest weighted component of the S&P 500, for the true laggard. That was only up 0.02% as measured from today's open. The energy sector remains in the top slot, both from the prior day's close and today's open, roughly 1.22, 1.23% in terms of positive change. Now, as we know, the energy sector is not really a heavyweight risk-on sector. It's the exact opposite. It's lightweight and risk-off, so not great to see that at the top of the list. And as we covered, these two are two of the heaviest weighted components of the S&P 500. Not great to see that at the bottom of the list. So this distribution here is fairly concerning when we see a green day in the S&P 500, especially when we're scouting for some sort of higher low pullback. I don't quite think that the market context and environment here, just based on, surface level distributions of sectors, is supporting the theory that we can find a higher low just yet. Now, we've omitted one last heavy-weighted component. That's going to be the XLF, the financial sector. That was towards the top, but up about 0.5% from the prior day's close, 0.71% from today's open. Let's dive into the structure now and see how these trends are continuing to evolve. As we know, the energy sector has been breaking out here, and this pattern does not, this should not strike you as a surprising breakout. We know that it's D for defensive. We know that it's risk off. It doesn't mean that the pattern can't hold up. So these higher lows and equal highs, it made sense that this had a breakout here, but this is not an ideal look for finding that higher low bottom in the S&P 500. So because this chart continues to look bullish here, I would say that this is a risk-off indication for the S&P 500. Something that would look better for trying to find that higher low bottom in the S&P would be a pullback into the breakout level or some sideways activity around it, just not blatant continuation to the upside. Again, remember that this is D for defensive. As this moves higher, it's not a great look for the S&P 500. Obviously, energy prices that are high puts pressure on the consumer. Therefore, there's less spend on things like technology, which drives growth in your economy. So overall, XLE, keeping an eye on it as this breakout continues to unfold. Next up, we've got the real estate sector. This is a really lightweight sector, so we're not going to spend a whole lot of time here. Remember that this will not make or break the S&P 500. Instead, if this is moving in the direction of the S&P, it'll just be slight pressure to support the move in that direction. Nonetheless, the pattern that we're starting to watch out for here is, of course, your head and shoulders right around a prior area of resistance. So do we roll over underneath this neckline is the question. Under 43, slight bearish drag for your S&P 500. Next up, we've got the XLC for the communications sector. This one is a heavier weighted component, not the top 3, but definitely still worth monitoring. This is a very bearish chart. We've talked about 2 failures in the past. First failure was this right here, failure to break out and hold above 57. We were back underneath. Second failure was we had a double top. We had a breakout. We put in a break and retest. Great looking hammer candle. No follow through whatsoever up and over that hammer high. And we've even closed underneath 57 2 days in a row now, Tuesday and Wednesday today. We've also closed underneath a 50 SMA and underneath and breaking this support trend line here. So the XLC communications look absolutely horrific in terms of being supportive of a higher low in the S&P 500. Of course, this upper wick, again, this dual rejection at that 50 SMA, the lack on the backtest of the support trend line, nothing about this really strikes me as overly positive for your S&P 500. So anything that now remains underneath 57, I've got to look at it in a bearish light, considering we've got 2 failed breakouts now. So as you can see, I'm willing to change my tone as the chart structure would suggest, and we're starting to get to that point. I was pretty bullish the past couple of weeks, slowly shifting to neutral, not willing to go bearish yet, but definitely in the XLC, a little bit more bearish there, obviously. XLF financials are up next. What do we see with this chart? We're still above this level, so 3373, 3375 is ultimately a line in the sand. Again, don't get me wrong, the chart in the short term is definitely bearish here into the level, but in the grand scheme of things, I'm really scouting for that higher low off of this area, the 3375. If financials can turn off of this level. That would help support the idea that maybe the S&Ps start to come into a bottom. Of course, if energy wants to cooperate, if the heavier weighted sectors, which we'll get to in a moment, start to cooperate, that would be the area that you want to see ultimately hold as a line in the sand. 33.75 in your XLF. In terms of the look of the chart here, inverted hammer, technically we opened on a very, very subtle gap down, and we rallied and closed up towards the top end of that inverted hammer. So in the short term, day to day, I think a little bit of a short squeeze can be produced if we take out these highs here, the 2-day highs of the red candles, roughly around 34.45, to squeeze out shorts who are positioned with terrible trade location. If that happens, of course, that's your higher low scenario in the XLF. So keep a close eye on something like that. Next up, we've got the XLY. What's going on in consumer discretionary? Again, a heavier weighted component. We've talked about the look above and fail completing. We've moved to the bottom end of this prior range right here, and now we're just going sideways. The chart does look fairly heavy. I would rather put this one in the neutral to slightly bearish camp as opposed to the XLF, which is slightly more bullish, simply because of the fact that we looked into this gap overhead at the highs of today's session, and we failed there. The buyers did not push to close the gap. Instead, the sellers stepped up, and we closed back in the midpoint of the red bar and even inside of the prior day's range. So instead, in this one, I would be watching out for a new short trade underneath 162.50 to see if we can close this gap underneath. Ideally, that's kind of all the selling we get, and then maybe there's a reversal off of that to help support a higher low in the S&P 500. If that doesn't happen, you know the deal. We will, of course, shift our tone underneath this gap fill area around 157. Next up, we've got industrial. 7% of the S&P 500. We'll speed it up through the lighter weight sectors. 3-day balance, basically a little bit more acceptance towards the highs of the 3-day balance, so more neutral in this overall area. Again, it can't be bearish yet unless we break down underneath 96. That would obviously violate some structure, so just being patient in this one. If we take out the top of the range, I would expect the rotation here. Slight bullish pressure for the market. If we move lower, it's all about holding at 96. If it breaks down, obviously we will shift our tone. Next up, utilities. Falling more similarly into a camp like the energy sector. I mean, again, think about your breakout here, break, retest. If this holds up for a higher low and we continue to push into new all-time highs, that again is more of a risk-off defensive look for the marketplace. And if utilities and energy continue to move higher, obviously we're not quite ready to find that higher low in the S&P 500. So I'm watching all of these things in conjunction to try to determine when the market context is right for getting aggressive back for daily trend continuation to the upside in the SPY, okay? So that's how all of these sectors ultimately come together to paint the full picture, and hopefully you can kind of get the sense for what I'm watching for in each individual one. XLP, technically D for defensive. It is more of a risk-off sector, but it's pulled back. It's fine. It's also, playing nicely with the broad market. Now we have a break and retest at this prior level of resistance, so it would be ideal if this just hangs sideways in here. That would be a decent look for our marketplace. So go ahead and watch 75.66 as a critical area of support. Any chop through here strikes me as fine, neutral, and then breakouts can continue up and over 77.23 for trend continuation. But here's the caveat, right? This is D for defensive. We would want to see larger moves in the XLV, XLK, XLF happening before this got breakout continuation above 77.23. Next up are the materials sector. I was about to say builders, XLB builders. Nope, but it is materials. Same idea, basically on the break and retest of this level. Looks decent. Lightweight sector, not going to make or break the marketplace. So we'll move on from here. If it's moving higher, again, slight upward pressure. If the market's moving higher, it's going to be a bit of a boost. If it's moving down and the market's moving higher, very, very, very minor drag. I would not read into it too much, right? And the same is true, but opposite for the downside. Next up is the XLV. This is where I need to shift my tone. You guys know the hashtag on Twitter, right? Hashtag here we go, IWC. MT. I will change my tone when these structural elements start breaking. And what do we have in the XLV? Certainly a break of some structure here. Here was a balance area. We had a look above and fail. We moved to the bottom end of the range, and now we're breaking the bottom end of that range with a 3-bar play into tomorrow, right? So technically we have trend continuation, a small resting bar in the lower third of the overall move here. Technically on a smaller time frame, it would be a bear flag, right? Sitting right atop the 50 SMA. If these two lows break right here, kiss this thing goodbye, I would expect we move slightly lower towards this area of prior support. What is the number? I would just roughly eyeball it here closer to about 128. Of course, that's big bearish pressure for your S&P 500 because we know this is the second heaviest weighted component of the S&P. So definitely keep an eye on your XLV. Anything that now remains underneath 130.50 is bearish for our marketplace. We talked about this in the pre-market live stream. This look above and fail and now break underneath the bottom end of balance is even more bearish as opposed to if this never happened here. Reason being is you now have disappointed longs who are trapped up at the highs, who will start to close out when they realize, okay, we've broken structure, we're not moving back above 130.50, time to look for lower and bail on these positions, right? So this chart does strike me as a big concern for the S&P 500. If for some reason there's a miracle bounce and it moves right back into 132.70, fine, we'll shift our tone again back to the neutral camp. We can only be bullish in the XLV for a positive force in the S&P 500 if this takes out this recent set of highs here on the fake breakout to the upside. So that is my sort of first foray, if you will, into the bear territory on some of these charts. XLV is the first one to flip the switch. Next up, we've got the XLK. What's going on here? Can we say we're in the bear camp yet? Not really. We're still above this prior set of highs. Obviously, the support that was in here, we will shift our tone if we break underneath that 142. As long as we're above it, I would be more neutral in this general area. Ultimately, we can't really be that bullish. Obviously, big gap down that didn't fill whatsoever. Bearish price acceptance at these lows. You know, we hardly got any acceptance in the prior day's range today. So again, it's hard to be bullish here, that's for sure, but I'm definitely still neutral until we breach these sets of highs here. I think it's very difficult to be a new money short down at these lows, literally sitting on support. This does not strike me as a wise place to initiate new shorts. I think what everybody kind of wants here is either a little bit of a rally, confirm a lower high, then we're scouting shorts, or a breakdown of this level. You kind of get this really ugly head and shoulders pattern, right? There's your shoulder mark. That could initiate new shorts as well after a lower high. So for now, we're neutral. In the short term, this does not look great for the bulls, but it's also not attractive from a risk reward perspective to initiate new shorts here. Overall, the implications for the broad market would be, hey, we're kind of hanging on by a thread for that higher low scenario in the S&P 500. So again, you guys thought I was just way too bullish in the past. Well, I'm shifting my tone, and now is the sort of evidence of that. Here we go with the ratio grid. If you don't know what this is, top right-hand corner describes how to set it up. Let's talk about it. Top four are our risk-on sectors. The XLK is coming into an upward sloping 50 SMA. So I would still give this one some wiggle room and say, all right, it's still all right. It's still bullish here. This is a bullish look of a chart. It's not all out bearish. That's a risk-on indication. XLY just below it also looks about the same, hovering above an upward sloping 50 SMA. Ultimately net neutral right here, but the overall chart strikes me as having a bullish look. That's risk on. XLV, risk off, hanging out down here towards the lows. We know it was the laggard on today's session. XLF, tangled up here, really more neutral. So the top four, our risk on sectors, are kind of saying, hey, we're not really that risk on. We're not all the way there yet in the risk on sectors. Down at the very bottom, we have the risk off sectors, and notice how these things are starting to perk up. XLP, upslope right to the 50 SMA. The 50 SMA is the gold line, by the way, on these charts. Energy sector screaming to the upside, making a new high above the 50 SMA. Real estate ultimately sideways. We know that that chart was down. And utilities also perking up above an upward sloping 50 SMA. So risk off is saying, hey, we're kind of risk off right now, right? So balancing these two things out, you can certainly get the sense that neutral is the right outlook here in our marketplace currently. Let's take a quick peek at our TNX because some interesting things have been happening in the 10-year and the bond market. We talked about on the weekly watch list update, this big gap up on Friday, right? Due to some overseas inflation data. Well, look at what happened. We did continue to trend to the upside. What I had mentioned in the Sunday video was that a trend that kind of looks like this is dangerous for your XLK. We know that the rough relationship between the TNX, the 10-year rate, and the tech sector is that when this goes up, tech generally suffers with a little bit of downward pressure, right? Future profits aren't as certain when interest rates are not stable, and obviously the higher the rate, the more they have to sort of cut into the profit margin in the tech sector. So ultimately, that's the relationship. And what I also want to point out is if we keep track of the target rate probabilities for the next Fed rate hike, notice that there's been a clear shift here. In the prior video, the 50 basis point camp was the one that was larger. Now you can currently see that has shifted over to an expectation of roughly 75 basis points for the September Fed meeting. So just keep an eye on that TNX as that continues to rally higher. I think you'll start to see more and more people fall into this camp, and the odds of that 75 basis point rate hike increase. Back on over to the platform here, taking a quick peek at the VIX. VIX is interesting. Obviously, we spiked higher on the Monday gap down in the SPY, that is. So this gap's up here in the VIX. And now we're cooling off. We're honestly quite sideways. It's not like this continued to take off and continue to see upward pressure, which is very interesting because we know if we look at the VVIX, which is the volatility of the volatility index, look at what happened. It perked up. Obviously, it didn't even get close to 103, but it did perk up and then it fell off an absolute cliff all the way back down to that historic level around 85. So you put 2 and 2 together and you take a quick peek at something like, we could do it on the SPY and the SPX. We'll look at the mother of all products. If we do something like this, close up the option chain. In the SPY itself, look at the put sizzle index. It was actually lower than a 5-day rolling average as we possibly had the opportunity for shorts to position themselves. So no one's out there buying SPY puts. What about the SPX? Because usually that has way more dramatic reads, right? So if we go on over to the SPX and we collapse all this stuff, look at what happened here. So yes, the sizzle index is, really, really high. It's 5.5 ultimately. But if you look at the call versus the put sizzle index, put sizzles were way less than the call sizzle, right? This was about 7 and this was about 5. So by a factor of 2, the puts were being bought way less. And again, you can say, well, okay, people were selling the calls, which is technically bearish. Well, that's not the case, right? Because if we look at the VVIX, it means no one's buying. Okay, if we go back to the VVIX, there we go. It means no one is a buyer of VIX calls. And if no one's a buyer of VIX calls and the VIX isn't moving higher, then no one is a buyer of SPY and SPX puts, right? So overall, when you put 2 and 2 together, no one's really that bearish here after the gap down. I think people are saying, whoa, 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 let's hold our horses and not get overly aggressive just yet in the S&P 500 now that we're sitting on, so let's talk about the levels now, the lower edge of the weekly expected move. So does it make sense that the market's just kind of ranging out here? Absolutely. This is the move. This is ultimately what the options market priced in last Friday. And we're just sitting right on the lower edge of the expected move. So there's 2 things that will generally happen here. Number 1 is that you get a breakaway situation, and now everybody piles into SPY puts, everybody piles into VIX calls, and you get sort of a gamma squeeze nastiness to the downside. It just absolutely gets horrific. Usually you move outside of the 1 sigma deviation, you get to 2, and then it's just, all out, hell breaks loose, for lack of a better word or expression, right? So I don't think that happens based on the evidence that we've seen so far, and also still technically being in a daily uptrend here on the SPY daily time frame. But it is a possibility you need to have in the back of your pocket. Instead, what I think happens is we just kind of hover out in this range or get drawn towards the bottom of the Monday gap down. So some levels to be paying attention to. I think shorts late to the party can get squeezed if we take out the 2-day highs here at 415.35. It was the highs from in here as well, and it was the highs from over here. Keep in mind, we filled the CPI gap up, that was this right here, to the T on the Monday session. So support does seem to make sense at the lower edge of the weekly expected move. We talked about this in the Sunday video. So again, shorts can get squeezed if they were new money shorts at the lows here. If we take out the 2-day highs, 415.35, I would expect to move at least to the bottom of the gap, 417.20. And if that breaks, obviously the Monday gap down is the next up to fill. Overhead from 417.20, 421.20 fills the gap overhead. That's sort of my expectation on the bull side if we can take out the 2-day highs, 415.35. Otherwise, my expectations are really, really muted here sideways. There's really no reason to be getting overly aggressive on the short side, again, unless there's some big 2 sigma move to the downside, which is generally more rare as opposed to happens, more frequently than not. I'm not seeing the excuse to chase it short. We're basically in a daily uptrend. So I'll end on this for the SPY. We're in a daily uptrend with higher lows, right? We know that this general area on the weekly time frame is a high volume node. It doesn't make sense to be a new money short at support. I can totally understand if we fill the gap and roll back over after a lower high to be a new money short here. Yeah, totally makes sense. Lower high, breakdown, pullback, whatever you want to call it, that makes sense. But we don't have that situation. We're extended to the downside. We're at the limit of what the options market priced in, and all of the data points that we've seen so far are mostly neutral, with the exception of the XLV, the healthcare sector, being the only bearish sector where we have flipped the switch. So that's what I've got for you in the S&P 500. Let's continue along and take a look at the internals. So I suppose we're still on the S&P 500, but we're done with the SPY chart. If you don't know how to set this up, again, I've got a video in the top right-hand corner that's got you covered. We're going to look at a couple of things here. So Monday, obviously, the outflows were big time, negative 300 million. What have we gotten since then? very, very, very neutral market. So there does not continue to be very much selling pressure even as we're going sideways, right? Everybody's kind of, taking a break from stepping on the gas to the downside and saying, whoa, let's hold up here. We traveled pretty far, pretty fast. Let's see, give this thing a little bit of time to resolve. Okay, so breaths, kind of neutral here. Again, not really a big indication that people are positioning for a huge new money short in this market currently. The advanced decline line would support the same thing. We were way over correlated on the Friday and Monday session. We talked about this in the Sunday video, and look at what happened. We finally neutralized it as we move back higher. So we're not overly correlated anymore. And this, to me, is just an indication that, again, same idea here. Nobody's really aggressively pushing for new money shorts just yet. Next up, in the tick, basically looking at the cumulative reads. Friday, big read. Monday, big read. Those were our two big trend days to the downside, right? A lot of that was priced in with the gap down on Monday, but regardless, two flat days. So across the entire market on Tuesday and Wednesday today, it was really, kind of net flat out there in terms of what the overall direction was in the market. Again, just an implication that it's not like everybody was just continuing to slam it short and we're waiting for the SPY to catch up to some sort of big breakdown here. So that's what I've got in the internals. Last thing we'll look at is the market profile here. What do we see in the profile? I want to continue to sort of talk about what I talked about in the Sunday video, which was just that we have this, A period liquidation break that takes us to a balance period right here. It's not like we saw continued trend throughout the course of that Friday session. Of course, we get the big Monday gap down, but look at what happened here, right? So kind of balance and kind of balance. This is important because it sets up two distributions to be paying attention to. Where have we accepted thus far? Definitely in the lower distribution. All of the points of control here are in the lower distribution, which is noteworthy. So two things, two ways to read into it. Number one way is obviously that this is where people are willing to transact, willing to do business. That's fair value. The next leg could be lower based on people not wanting to push it up into the upper distribution. The other possibility, of course, is that people are turning into net buyers here on the higher low pullback in the SPY. I think it's a little too aggressive. I would not want to be the first one in the door here at the bottom. But if this is now where people are accumulating buying positions at these points of control, now they're positioned quite nicely for a squeeze over the two-day highs and we get continuation. So regardless of how you want to read into it, I would say we're still not really doing anything much different than watching this level right here as a first upside indication. It's a weak, or I shouldn't say weak, it's technically a mechanical level. Actually, it is a weak level. It's not a poor level is what I should say. It's a weak level because it's the value area high from here. It's the high from here. It's the overnight high, and it's today's high as well. So a weak level, very nuanced visual level that traders can see. If we break it, buy stops should be triggered for the move higher. The last thing I'll point out from the profile perspective, and if this jargon's not making sense to you, again, I've got another tutorial for you in the top right-hand corner. Someone pointed out in the live stream this morning, thank you so much for pointing it out. I can't remember exactly whose name it was, so I apologize for that. I'll figure it out and I'll give you credit where credit is due, but they said poor low on the Tuesday session. Absolutely correct. We moved through the low on today's session, repaired it with good excess, and now we've moved higher. So this auction at the bottom is technically complete from that perspective. So again, thank you to the person who pointed that out, and I figured I would mention it to you all here on today's stream as well, which again is noteworthy that this completion of the auction would suggest maybe there's the possibility for higher over this mechanical level that we've just identified, roughly 4160 in your ES. That's going to do it for the S&P 500. Let's take a brief tour through the remaining components of the broad market here. What do we see in the QQQ? Slightly more bearish with three equal lows. Obviously, you've got a larger gap overhead. We filled and are well underneath the CPI gap, right? So I guess technically it didn't fill because this was not in a regular trading hour session, but this is now just a double gap. So treat that as exceptionally poor structure over 318.75. Again, I think a squeeze can come up and over 316.50 for a rotation to that. I don't think now is the time to position for new money shorts as we've seen an aggressive pullback. Majority of that move was the gap, right? And we're moving into this prior area of resistance, which was then support here. It's the weekly high volume node, not ideal to be positioning for a new money short. You would want to see if you have a short bias, that's fine, but you need a better entry. You need a lower high, a reattempt, and then something that does this. If you're just shorting in the hole here, as we would say, you're kind of chasing, right? And although it may work out, it's a bad habit to get into. So those are my numbers in the QQQ. 316.50 unlocks the upside squeeze. I would not be positioning for shorts. Any further downside trickle, watch 311 like a hawk. Next up, we've got IWM Russell 2000 and the small caps, what's going on over here. Definitely more of that risk off sort of neutral indication. The reason I'm slightly more neutral in here is because, of course, our prior high is holding up. This is slightly more bullish than many of the charts that we've seen on today's session, with a nice strong candle close at the highs of the 3-day range instead of at the lows, or even threatening a new breakdown on today's session. We are still contained within the weekly expected move, and 190.71, as we know, was our line in the sand. So yes, considering that this is a risk on, risk off indicator, that, that's how we use it, this is more of a neutral implication on this bearish pullback. But if we start to perk back higher, that to me might be an indication, okay, watch and see what your S&P 500 sectors ultimately do. If IWM can start rallying, maybe the tech sector, maybe some of these more heavyweight risk on sectors actually pick up slightly in the S&P 500 and we catch that higher low. So watching this closely around 190.71, I really want to see how this 3-day balance resolves. If it's to the upside, I'm personally going to start looking for the excuses to find the higher low in the S&P 500. Now, of course, we're not going to pull excuses out of thin air, but if things start aligning, that makes sense, right? So that makes sense. All right, continuing along, Apple, core list of companies. Let's kind of breeze through them. I've got 6 additional ideas for you. I've got a lot of stuff to cover in today's video. Obviously, this is your pullback level that we want to see hold at 167. Hammer candle on today's session. We technically looked underneath the 2-day range and failed back into that 2-day range. So let me zoom in on that a little more. That might be a little bit better. You can see that lower wick. So to me, buyers did step up. Again, a bit extended to the downside. We've seen a full retracement of this prior breakout. Very rare that you just immediately see continuation through that. So if we can take out these highs, we're looking for the 171 overhead. If that produces a lower high, then yes, again, this is where you can look for that new money short in Apple. But until that happens, not really ready to sort of try to chase a pullback at this point in time. We know that Apple has been the relative strength monster, fully giving us basically a V-shaped recovery off of these lows. So Apple is probably the last place I would want to look for an aggressive short. So those are the numbers. Obviously, if it breaks 167 with acceptance to the downside, your next target underneath is 163.25. But as I've just pointed out, that doesn't really strike me as a wise situation to put yourself in. Netflix is incredibly neutral here, so I don't want to spend a ton of time on it. We never got into that gap overhead. Remember, there's 80 points there to be trading for, so you don't need to nail the entry at 250 literally. You can wait for some structure to build out. This does strike me as being the most bullish on today's session, just noting where we've closed here and also looking at percentage points. I guess that the meta trade there is going to be pretty bullish as well. We'll take a look at that chart in a moment. But overall, I don't want to get chopped around in here. I don't really think that there's a short trade here. If we take out the 3-day lows, you've got support right here. So again, I'm not seeing the short, that's for sure. And I'm also not, there's no long here. I think that the long, again, I've pointed this out a number of times now, 250 and above. So day trades, fine. Maybe something about this 3-day balance, fine, but I'm just not in love with the structure of the Netflix chart currently. So we're going to move on. Next up is Tesla. This one does strike me as interesting because we have a balance here and we're also coming into the split tomorrow. You guys can let me know in the comments section. I didn't do my research here. I believe most splits take place post-market. So let me know. If you know that it's going to happen pre-market, then definitely let us know today. We'll, of course, find that out in the pre-market live stream tomorrow. But regardless, coming into the split, rejection off of the sort of upper third of the range that we've been trading in that box that I've just drawn. At first, this was the relative strength monster on the day. It was the one that was up the most as everything had that initial pullback in the morning. And now look at how it's closed. The only red name on our list with the inverted hammer rejecting the bottom end of this prior 4-day range here, rejecting the 200 SMA. I would be looking out for shorts inside of Tesla on the failure to hold up at those highs. I think that the hourly time frame chart does a great job of illustrating this. Again, we had this beautiful strength here in the morning and then faded off into the afternoon, looking for shorts underneath this 890-ish zone inside of Tesla for a very micro hourly head and shoulders pattern, right? Boom, sends us to this level here. 865.70. And of course, the split should cause lots of volatility, just meaning that the stock should be moving tomorrow for sure. Next up, we've got GOOGL. What's going on in GOOGL? Taking a look here. Chart does strike me as being more bearish than bullish. This is in the XLC sector, obviously. That chart does not look great. We have 3 days of balance, ultimately sideways activity. I'll give credit where credit is due. A little bit of a lower wick on the fake break, closed back inside of the 2-day balance range, but ultimately, big failure to hold outside here. So I do think that over time, the target should be closer to 104. I'll be watching this one like this. If we get price acceptance underneath 113.50, looking for lower into some of these interstitial levels, namely 111.50 and then 108.25. I think that's a bit of a stretch into the end of the week. If we move higher and the entire market sees a short squeeze over the 2-day highs, I'm not really willing to trade Google until we get into the gap because there's no structure there, and we know that there's relative weakness in Google as opposed to strength. Next up, we've got Meta, which again had a bit of a decent day, at least in terms of percentage points here. What's the structure say? Again, actually not bad, right? 3 days of balance now, neutral in the midpoint of that balance. And I would say if we take out 166, look for a retracement, scene of the crime. Maybe we head back up to 172.56. That would be the upside look. Doesn't make sense based on a range doubling perspective. I might start to look a little bit early to take some profits off the table, 170.50, 171, that general area in there. If we were to take out the lows, there's some room to move lower into 155.65. That would be a 100% retracement. So your downside risk reward is getting limited inside of Meta currently. I wouldn't push my luck to the downside here for anything more than a day trade with a trailing stop because again, we've made this much move so far. Are you going to trade for this much now that we've already done a majority? I don't really find that as a wise trading strategy, pushing your luck at the lows as we're coming into support. So that's Meta. NVIDIA, of course, earnings happening right now as we speak. Let's go to an hourly and we'll just quickly flip on. Where are we? There we go. The extended hour session and see what's going on from that perspective. A little bit of a gap down, it looks like so far. Some big red nasty bars hitting the marketplace here. It does look like we'll open on a gap down. Just to give you the framework here, we'll update you in the pre-market prep, of course. If we open, so let's put in the overnight low as well, then we'll zoom in on that a little bit further and we'll put it front and center. All right, so if we open here, fail to take out the overnight low and trade long through the open, you're looking for a retracement to close the gap to the prior low of day because you have net longs who are at terrible trade location. They failed in the regular trading hour session. Then you're looking for long to close that gap. Again, we'll update you at 9 o'clock or whatever tomorrow during the morning live stream, but that's ultimately the structure to be watching out for inside of NVIDIA. So not much else to say other than that. Of course, earnings, there's always a curveball, so one step at a time there. Microsoft up next, big weakness in this one. Trend days lower instead of going sideways here. 2-day low breaks get us into 273.50. If we move higher above this 277.30, look for the bottom of the gap. That's kind of where your short squeeze can happen from. Overall, not really impressed with this chart. I think that there's some better structure that we've seen so far just because our downside target's so limited and the upside's not even really that attractive because we are in more of a downtrending environment here as opposed to a balanced environment. Last but not least, Amazon, which looks heavy. This was a top short watch on today's session. It did not pan out. Doesn't mean it can't pan out into the remainder of the week. This big juicy gap is ultimately what we're looking at. Chart looks heavy. Upper wicks obviously stacking on the gap down from Monday. If we crack the 3 equal lows around 132.50, opens the door for the gap fill trade. Wouldn't really want to trade this one long unless it's for the gap overhead and a break of the 3-day balance highs. But even that is, that's just a very, very quick scalp in and out of something like that as we literally head right into resistance, the scene of the crime from the breakdown. So overall, Amazon, I would prefer to trade this to the downside through the gap. All right, we had 6 trade ideas to share with you, so it was so many, I put them in a watch list here. AMD is up first on the list. Can you believe it? AMD making a reappearance. So if you enjoy AMD, AMDizzle as we used to call it, let us know in the comments. Anyways, we're going to speed it up here. Obviously, a break and retest of this level. Hammer candle printed on today's session. Failure from the sellers to drive it lower underneath the 2-day lows. It's happening at critical structure as we've just pointed out. If we can take out the hammer high, target your resistance trendline. That's a bullish trade. Obviously, this kind of sets up a rough 1.5, 2-ish to 1 risk reward ratio if you're a swing trader. Ideally, we're just looking at it for a day trade structure though. Next up, we've got PayPal. What's going on over here? Just like Amazon looking pretty heavy with the 3 inverted hammers, lack of any follow through to the upside. We made a new 3-day high on today's session, pure rejection back down into the range. If we breach the lows, fill the gap down underneath into 90.64. Pretty self-explanatory on that one. Also a day trade there. Coinbase, we're revisiting it. We talked about this descending triangle. Obviously we gapped down and that was a pretty tough trade to catch. But now again, you've got 3 heavy inverted hammers. If we breach the lows, target your support trend line. This is also bearish because we're setting up right above this breakout level. Again, the hourly time frame chart might do a good job of telling this story. If we grab the other tool and zoom in, it was where we got some breakout from, right? So right where there was consolidation here, next leg higher. If this whole area fails around 69.35, we'll call it, again, support trend line is on the table as a target for either a day trade or maybe a 2-day trade, something that looks like that. Next up, KHC, Kraft Heinz. This is a longer term pattern, obviously. We've got a breakout zone here between 30, let's call it 39 up to 39.30. If we take it out, look left, really thin structure in here. Target would be the bottom of this zone, up around 42 to 42.40. You want to see it remain to stay on the sort of watch list here above 37.78. If it breaches that, off the list, get in the boot, no longer interested. Next up, Walmart, gap fill reversal on this guy. Obviously, here is your earnings gap up. We filled the gap. Can we reverse off of it now that we've repaired the structure? We're supporting at prior resistance. 2 back-to-back hammers if we take out the highs at 135. Again, thin structure on the way up. Back to the scene of the crime, the 3 equal lows, the daily 200 SMA. That is 138.50. Stop wants to go underneath, or just not interested in the trade if it dribbles underneath the gap close area. Next, last but not least, Airbnb bullish engulfer on today's session. 2 back-to-back inverted hammers. Bullish engulfer closes above both of the wicks, and we've got thin structure on the way down from the breakdown. So again, scene of the crime is the target 120.50 on the upside. So again, think about the shorts who are trapped here. Shorts trapped, shorts trapped. We opened underneath the red bar's low, so technically it's a gap down underneath a red bar, and we've closed firmly above. So shorts, all of them are underwater who are positioned in those 2 bars there. As long as we're above 114, I do think some more squeeze can come to take them out and again go back to the scene of the crime, 120.54. That is ultimately going to wrap up today's video. If you enjoyed it or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget that we will be live at 8:30 tomorrow morning, and I wish you all a green trading week.